Welcome to the program, Michael. It's great to have you back.
Hi, Simon. How are you?
Very well. And for us in Sydney, we're locked down. So 4 weeks in, and things aren't changing.
Yeah, thanks for reminding me. Yeah, no, thanks for reminding me about the lockdown. I'd forgotten about that. No, we're not going anywhere, unfortunately. Most probably for the rest of August, until the end of August at the earliest.
Yeah, I'd agree. And how are you finding the markets? And I believe bond yields are things to watch.
Yeah, look, I think since we last spoke, the biggest sort of movers have been the bond market and I guess the FX market. Equity markets haven't sort of been doing a lot, and commodities have been fairly volatile, but they still remain very strong. So a lot of the focus has been on the bond market, partly driven by central bank comments, maybe partly driven by risk aversion. We've seen long bonds come off quite dramatically. I think when we last spoke, the 10-year bond yield in Australia was about 1.6 or thereabouts. Today we're around 1.2. So that's quite a dramatic drop after we peaked early in the year at about 1.9%. And if you think back earlier this year, one of the reasons we saw bond yields going up so quickly was the reflation trade, and people were concerned about inflation re-emerging with all the stimulus post, the emergence of COVID early last year. Ironically, certainly in the US, inflation has re-emerged, and I think over there you've got short-term inflation hovering towards 5% or in that vicinity, and even the 5 to 10-year inflation expectation in the US is only just under 3%. Yet people are happy to buy bonds and effectively lend money to the government there for 10 years at 1.2%. So my understanding is that we're currently seeing the highest ever negative real yield on long-dated bonds. That's a reflection of risk aversion, yet we've seen equity markets remain pretty well at all-time highs. So there's a few disconnects there, but the bond market's most probably been the surprise packet, to be honest, particularly as central banks are sort of announcing a bit of a winding back of quantitative easing and bond buying programs. So when you look at that, and certainly the inflation in the US, not just the headline number now, but the expectation, you'd expect bond yields to be higher. So that's most probably been the biggest surprise over the last sort of 4 to 6 weeks, to be honest.
For sure. And what's been happening in the currency markets as a result?
Well, the currency markets are sort of caught up in a few things. Like there are some very different messaging from central banks. So the RBA in July have announced a reduction from 5 to 4 billion Aussie dollars in their weekly bond purchases, but they're still maintaining unlikely for conditions to be met to raise the official cash rate before 2024. Those conditions are inflation sustainably in the middle of the 2 to 3% band and wages growth at 3% plus. Even though they've left the door open to maybe having to go earlier, you contrast that, say, with the RBNZ, who have announced an immediate cessation of their asset purchasing program, and markets are now pricing in potential rate rises in New Zealand from this year. So if you look at, say, the Aussie Kiwi, it's dropped maybe from about around 108 to 105.5 on the back of that revised interest differential forecast. So the 2-year interest rate in New Zealand's jumped from 0.5% to 1%, whereas in Australia it remains flat at 0.25%. So the Aussie dollar is certainly coming off on those either interest differentials or perceived future interest differentials being more negative and more weighted against the Aussie dollar. So that's certainly been a factor in the lower Aussie. We've seen the US dollar strengthening from the most recent US sort of central bank comments, again about winding back bond purchases, and the market's reading the US as potentially raising rates from 2022. So we've seen the US dollar rally a few percent, but the Aussie's actually performed, has come off by even more than that. So I think the main drivers have been, apart from that interest differential and central bank story, has been the sort of lockdown of Victoria and New South Wales. I suppose if the US had more than half its country in lockdown, the US dollar most probably wouldn't be rallying either. So that's certainly weighing on the Aussie dollar, particularly with our really slow vaccination rate. And the markets are now looking at a negative third quarter GDP here. So, and there's a bit of a question mark around, with the end of sort of JobKeeper, JobSeeker, what sort of fiscal stimulus and government support people are going to get. So that's certainly weighing on the Aussie dollar, and that combined with, I guess, the central bank story and interest differential outlook has seen us actually trade sub 73 cents and at our 2021 lows. The most interesting thing, though, or one of the most interesting things, if you contrast that, Westpac have an index of our Australian export commodity price basket. That's at a record high, and that's risen by over 40%, about 40% since March this year. Yet the Aussie US is actually lower. Now, I've never seen that before. Normally, if I told you back in March when the Aussie dollar, I think it hit about 80 cents, that by July, you'd see that commodity export price index up 40%, but the Aussie dollar would be lower. You wouldn't have believed it. So you've got things like thermal coal hitting a 13-year high last Friday. It's up 63% in 3 months. Iron ore remains around $215 US a tonne. Very supportive. Yet the Aussie dollar is just totally ignoring that. Record trade surplus, record current account surpluses. It's very much in this negative sentiment around the COVID re-emergence and interest differentials. I think with the Aussie dollar, I suppose if you look forward, assuming we can get the Pfizer supply that we've been promised and everything else, and if you think that these the current lockdowns and I guess re-emergence of COVID may trigger people that were 50-50 about whether they want to have a vaccine, more likely now to have that, we could be in a very different position by the end of this year where we could have a vaccine rollout comparable or even potentially better in 6 or so months than a lot of other major economies. We've seen Canada not only rapidly catch up, but surpass the US in rollout quite quickly. So looking forward, if we're in a position where later this year or at the end of this year, lockdowns are sort of, we're through that and we're reopening at least domestically, and the commodity support's still there, you can certainly see the Aussie rebounding. So I do think the dip is still to be bought. The challenge at the moment is how far that dip is. Is it 72.5, 73 cents, or is it going to go down to that really key long-term support level around 70 cents?
Makes sense. And you touched on a couple of commodities there. What are you seeing in commodities generally?
Look, food commodities remain really strong. I was having a look at things like coffee this morning have gone through the roof. So if you're into a caffeine fix, maybe you want to start buying a bit more. Things like sugar, wheat, the hard wheat in the US has just hit 8-year highs. Corn. We've seen a lot of food commodities, pork, lean hogs, all those things are incredibly strong. Obviously, some of the coal prices, iron ore, even things like copper and some of the base metals, whilst they've pulled back a bit, they're still historically at pretty attractive levels. So that's why the commodity argument is still supportive of global growth and certainly supportive of the Aussie dollar. That's why the bond market doesn't appear to really, that rally in the bond market doesn't really align with risk aversion. If you think it's aligning with a potential slowdown as COVID cases, even in the UK and the US, re-emerge, you would expect equity markets to most probably be selling off, and they haven't really done that. Or you'd expect maybe commodities to be selling off in anticipation of slowing global growth. So there is a bit of a disconnect at the moment, and that's my sort of history shows me that when in doubt, follow the bond market. That generally is the leading indicator. So yeah, I think that's a key watch out in the next few weeks and months. We're not seeing that unison of markets right now, and there does appear to be a bit of a disconnect.
What's the what should treasurers be keeping their eyes out for then in the next month?
Pretty well anything and everything. I think we've closely got to watch the COVID situation in Australia. Certainly, if you've got Aussie dollar exposure. I think the dip in long-term yields, if you believe that the next 3 to 6 months, we will come through this, not just in Australia, but as we get higher vaccine rollouts, and assuming they continue to be effective against mutant strains of COVID, you'd have to think this dip in longer-term yields is a good opportunity to start fixing some. If you've got long-term debt, you'd have to think this is a really good opportunity. I think it's a good opportunity for exporters. They've got the double benefit at the moment of high commodity prices and a low Aussie dollar. So I think there's a great opportunity there. But I think you've just got to really watch the trends in COVID. I'd closely watch the bond market, because I think that's always got clues in it. And I suppose the other challenge will be trying to navigate through economic data. Like, if we get a negative third quarter GDP here, what does that really mean? Even if you look at unemployment, you've got it, I think, on an 11-year low, nearly at 4.9. But if you look below that number, beneath it, actually hours worked are nowhere near as compelling as the 4.9% unemployment rate is. So I think the data is going to be continue to be fragmented, difficult to interpret. And I think for any treasurers, anyone with financial market exposure, part of the skill will be trying to navigate and dissect data, break it down, but also try and work out what's a temporary aberration versus maybe something that's got a longer term trend in it. I think they're the challenges.
Well, Michael, thank you very much once again for coming on.
Pleasure, and enjoy your time down south. At least you can move around a bit more than us, hopefully.
Thanks, Michael.
Okay, cheers.